All right. So now that we've talked about what type of businesses to buy, I believe a key thing to think about and understand is understanding SDE, EBITDA, and add backs. All right. So basically, the key thing here is that when evaluating a company's performance, it's important to understand the difference between SDE, EBITDA, cash flow, net income, because you're going to hear brokers talking about it, and you're going to see that on CIMs and confidential information memorandums. And so understanding what these numbers all mean is important to understand kind of what you're looking at, because unfortunately brokers sometimes use it interchangeably. And so I want to talk about kind of the differences between the two, as well as understanding what you should look at as a business buyer, right? So first, let's talk about SDE. So that stands for Seller's Discretionary Earnings, right? And so basically, as you can see here, it's the net profit plus the owner's salary and discretionary expenses, meaning like personal expenses. And so typically the reason you hear a lot of times SDE being used is because it's supposed to be the total earnings available to the actual owner of the business. So in smaller businesses, the concept generally holds that these smaller businesses, they might not have a market rate salary, right? The owner can kind of pay themselves whatever they want. So they might pay themselves very high salaries. And also a lot of times in these kind of mom and pop shops or smaller businesses that are, 5 million of purchase price or lower or around there, that we might be kind of looking, the seller might be just using the business as their own kind of personal piggy bank, right? They might be also, spending some money on personal travel, writing off family dinners and vacations and things of that nature. So in reality, what we're trying to do here when we're coming up with SDE or EBITDA is we're trying to just understand the true cash flow generation potential of the business, so that way you can understand the true profitability. All right, so that's what we're doing when we come to SDE. And a lot of times it's used for valuing smaller businesses. But as you get larger in the business buying scale and you're looking at businesses 10 million and above, typically, you might hear the term EBITDA a lot more. And so what that is that it's a measure of the company's operating profitability outside of a few key things. So the way you do EBITDA is you find out the net income, which is the normal kind of measure on a profit and loss statement, right? And then you're going to add back interest, taxes, depreciation, and amortization. So that's what EBITDA stands for: earnings before interest, taxes, depreciation, and amortization. And the reason for that is because EBITDA is usually a measure that sometimes you'll look at when you're trying to compare businesses in a certain industry, because technically the way that a company spends money on interest, taxes, depreciation, and amortization, that's usually non-relevant to the actual business itself. And what I mean by that is you could have one business that, for example, has, no debt at all, and it'll be run and kind of performing and resulting in certain cash flow one way. But then you can also have another business that has MCA loans and a lot of debt and is now paying a lot in interest expense, right? And so that technically, just because the fact that they have a different structure in the way they're financing their business, that shouldn't actually impact the true cash flow generation potential of the business. And so that's why we add back certain things. Same thing with taxes, right? If you have a business that has New York or California taxes rather than a state that has no state income tax or no state taxes, then you're going to have different tax rates. And so that's basically why we have this measure. So that way you can take out what's referred to as like the capital structure of the business and not worry about how people are financing their business, and focus more on, okay, this business in its isolation, how much money does it actually make when you carve out, whether or not you have to pay a lot in taxes, or you carve out, special tax tricks you're doing with depreciation and amortization. So that's why we use these measures. And so depending on whether it's a small business or a larger business, you'll see whether on CIMs or brokers are talking about SDE versus EBITDA. Now, add backs are important because, kind of going back to what I talked about with SDE, is that you really want to figure out what the company's earnings are. And so you're going to remove certain things like, okay, we talked about owner's salary and discretionary expenses, right? Personal expenses like one-time travel, personal car, things of that nature that the business owner is just running through the financials to get like a tax write-off or something, or improperly doing it. And so this here, when we're doing add backs, we're trying to understand, again, what's the true profitability of the business. So if let's say they have some sort of real estate in the business, and 1 year they do a whole kind of renovation or a lot of tenant improvements, right? And they spend $100,000 on that. Well, that's not really related to the actual business itself. And so that 100K hit should actually be added back to EBITDA, assuming that, that's not going to be something that happens every year or every other year. Because if you take over that business and they've run it for 30 years and in just 1 year they decided to do those kind of renovations, technically that shouldn't hurt their profitability in the business. So that's kind of the thesis and background behind that. So this is kind of more in a table format to understand at least the difference between SDE and EBITDA. And, they use to serve different purposes, as I mentioned, right? Like SDE is to understand like the cash flow available to a new business owner, whereas EBITDA is more about like operational profitability. So it's more for use for like comparison basis. So these are the differences. And again, you'll have access to this, but basically when you're doing SDE, you're getting to the net profit. And all you're doing is you're adding back the owner's salary and then the add backs, like the personal expenses or the one-time expenses. Whereas you can see in EBITDA, there's a difference here where you're starting with net profit and then you're adding back interest, taxes, depreciation, and amortization. So that's the kind of key thing. I just want to make you aware because you're going to hear, unfortunately, certain brokers or kind of certain sellers using that interchangeably because they might not fully understand it. And so you'll just need to kind of verify when you're looking at a CIM or looking at financials, what are they representing as SDE or EBITDA, and how does that actually flow through, right? So like you can actually take a look at the net income or the net profit and determine, did they get to the SDE number by just adding back the owner's salary and add backs, or did they do other things as well? And that way you can get a true understanding of the cash flow of the business. So again, these are kind of differences when you should use them. So SDE is typically best for smaller businesses when the owner actively manages operations because, right, they're probably working in the business, they're taking some sort of salary that's kind of just whatever they feel like, and they're kind of getting all the extra profits of the business. Whereas EBITDA is usually ideal for larger businesses or companies. So you'll hear like public companies report on EBITDA and things of that nature. So that's the way to think about it generally. Now, I want to dive in a little bit more on add backs because this is going to be something important that you can't just take on face value from the seller, because when you're coming up with the valuation, right, you're going to be buying the business based off of a multiple of EBITDA or a multiple of SDE, right? So you're basically looking at the cash flow generation potential of the business and you're applying a multiple to that to come up with the valuation. Usually on average, as kind of for smaller businesses, if you're doing SBA financing, it's usually around the 3 to 4x. But as businesses get larger, that's, the multiple will go up. And so that's a topic for another time. But add backs are important is because they help you standardize the earnings and understand what the clear picture is of the company's profits. And so some of the common types of ones are ones we've talked about, which are like owner's compensation, right? Any personal expenses covered by the business, but then also non-recurring expenses. So if, again, the business moved one time after 30 years, right? They changed warehouses or whatever, all the additional moving fees, that's not a normal course of business, right? And so that shouldn't hurt their profit, and that should be added back for you to understand as a buyer that, hey, as long as this expense is not going to occur again, right, non-recurring expenses, then I can feel comfortable that I can pay for that additional cash flow. Discretionary expenses, these are the personal expenses we talked about, and then kind of interest, taxes, depreciation, amortization. Again, depreciation and amortization are not true cash expenses. Those are just things that the IRS and the government has allowed that businesses can take in order for them to have like a financial incentive to pay less taxes when they're buying assets, because you can depreciate that. And amortization is the same thing as depreciation, but it stands for like intangible assets. So things like software or websites or trademarks or goodwill, right? So depreciation relates to like real tangible fixed assets, meaning furniture, equipment, vehicles, machinery, things of that nature. And so that's kind of what we're doing here with the add backs ultimately. So as an example, right, if you have a business that you see that has a net profit of $300,000, right, on their P&L, but you see that they kind of took an above market owner salary, right, The owner is running the business however he wants. So maybe a normal person in his space would take 200K, but he took 250K, right? And then there was a one-time lawsuit. So business has been running for 5 years. They've never been sued before, or 10 years, and they have one-time lawsuit. Then again, this would be considered an add back. So if it's something that occurs often, and that's why kind of the legal due diligence is part of this as well, and you need to see whether or not they are incurring this on a normal basis or if it's just a one-off that isn't really going to happen or doesn't really happen historically. And then also kind of personal travel expenses, right? So if they just book their personal family vacation on the business, right, post-acquisition, when you buy the business, you're not going to do that, or the seller is not going to do that on your books. So that way the true earnings potential of the business is 380K, right? Because we started at 300K and then we added back all of these adjustments. So reviewing the add backs is good to make sure you understand that it's true profitability. But again, you need to understand add backs because you really need to understand whether or not it's a one-time nature and it should be a legitimate add back, or is it something that the seller is just trying to be aggressive about and trying to make the business look better than it actually is. So now talking about how SDE and EBITDA impact business valuation, right? This goes back to the multiple of EBITDA or multiple of SDE that I talked about. So for example, if you're buying a business that, let's say, makes 250K in profit, right? And you're buying it at a 4X. So you're buying it for $1 million. Now, that's pretty fair, right? SBA 7A loans and kind of current interest rates will allow you to get the deal done. You can kind of get it through a proper DSCR structure, which we'll talk about what that stands for in terms of debt service coverage ratio. But ultimately, that's kind of fair to be able to get the deal done. Now, every dollar that the seller is able to convince you is an add back, right? Let's say, going back to the prior example, let's say this wasn't actually a personal travel expense. Maybe they're trying to treat it like a trip to Disneyland, but maybe when they go, the seller is actually visiting some customers and clients, and that's a normal part of their business where that customer wants to see them once a year, right? If that's actual a business expense, then technically, if you were to fall for the fact that that's an add back, you're not getting a 10K loss hit. You actually have to multiply that 10K SDE by your multiple, which was 4X in our example. So you're actually paying $40,000 more because they were able to convince you of that dollar. So based upon the multiple that you land on, you have to understand that you have to be diligent in your add backs. And you should have, post LOI, which we'll talk about, soon, you should have an accountant that can do a quality of earnings and help you kind of make sure that the SDE and EBITDA numbers are fair. But just something to keep in mind of how it typically works out there. So common mistakes in financial analysis when looking at treating one-time expenses as recurring. Right. So now if this is, again, helpful to the seller, but something that you as the buyer just need to identify of, like, if you really like a business and you really want to make sure that the numbers work out, then you want to kind of make sure that you understand any non-recurring costs. So just because they say it's non-recurring, you have to actually understand it and kind of ask questions behind what happened and why it won't happen again, or else you'll need to treat it as a recurring expense. Misinterpreting financial trends, overlooking industry standards. So these are all potential, basically, common mistakes in financial analysis and things that you need to make sure that you're doing. You need to verify the financial data, right? So the sellers are just giving you exports or pulling it out from their QuickBooks. And again, they have nothing to lose, right? You're the one spending your money to buy their business. And so if they've overstated their earnings, right, that's just going to get you to pay more. So you need to make sure that you're doing third-party due diligence. You're hiring a quality of earnings provider post-LOI because, again, it's very rare that it's fraudulent, right? Even though that does happen in 1% to 2% of the time. But in general, these smaller businesses are probably not paying definitely not paying millions of dollars in accounting and finance kind of support and payroll expenses. So you can't expect for them to have all of their financial GAAP data properly set up. And so you want to make sure you're doing your own due diligence. Another key component, right, is really trying to figure out how much of the business success relies on the current owner. So that's a key thing to keep in mind of, is like, if the owner is only paying themselves $70,000, but they're only taking, they're running, they're doing 70, 80 hours of work a week in the business, then you need to make sure that you understand that you adjust the cash flow and the SDE accordingly, because you need to understand that you'll have to probably pay or hire one or two other people as well as yourself post-acquisition, which is going to hurt the overall cash flow of the business. So that's a key thing to keep in mind of, is that just because the owner has a certain compensation and we're treating that as an add back doesn't necessarily mean that that's where the buck stops, right? You have to really think about and model and project what is the business going to look like after you take over. And if that means you're going to make new hires, or if you're going to adjust the compensation, right? Or if the seller is even going to stay on post-acquisition, right? Then you have to kind of take in their new salary, as well as understanding kind of where you're going to land at from your salary. So all of that needs to be factored into what you see on the CIM, or what you see from the profit of the business you're about to buy. And then finally, underestimating hidden liabilities. Now, this is something that your lawyer will probably help you with. And so, after LOI, once you have a signed LOI and you're in due diligence and exclusivity, you will be in a situation where you can write up a purchase agreement. And typically, this is where you protect yourself from not being liable for any hidden liabilities, right? So like if there's things that they didn't mention or put on the balance sheet or make you aware of prior to the acquisition, then you won't be on the hook for that. So again, get a proper M&A lawyer. That's where you're going to spend the money on. But at that point, it'll have been worth it, because you're being able to buy a proper business for the cash flow potential of the business. So that's kind of key thing to keep in mind. So hopefully that all makes sense. I know that's a lot, but we've gone over kind of how to make the buy box. We're going to go over the CIMs component of it all and where that fits into play. So we're going to talk about that next. But then we also went over SDE versus EBITDA. And so hope you guys enjoyed this, and let's talk about CIMs now, or confidential information memorandums.